Wow, it's actually biblical. I don't know if you guys can see this. There's like marble-sized hail sitting on the roof. So, for those of you who don't know me, first of all, I have the pleasure to know a lot of people in this room. Thank you very much. My name is Matthew Kittay. I'm a partner at Fox Rothschild. Fox Rothschild is a law firm. We're in almost every state where this matters, where the legal industry exists. We've been doing this for 8 or 9 years, which is the longest any large law firm has done. And as a result of that, we've had the opportunity to really pioneer a lot of the structures and the processes and the relationships and the partnerships that have taken what I think is the case for a lot of people in this room: entrepreneurs, first movers, people who are going from the legacy market to the established regulated market, from small companies to regional presences, to national presences, to acquired targets. How many people want to do that with their company? How many people are really trying to grow something massive, right? So, and I think that's the opportunity. I think there are a lot of opportunities here in this space, but I think people are, need to think big. And as Jacoby was highlighting, and what I'm here to talk about today is probably one of the most basic things that you're going to be doing with your company. And you might think, like, this is early stage, this doesn't really matter. Well, I'm here to tell you, yes, it's early stage, but it matters from a legal perspective and from a corporate perspective. This is one of the most fundamental things that you'll have to do in the context of pulling your business together. If we look back 3 or 4 years ago to clients that I've represented in this space, whose companies I helped structured, whose operating agreements or shareholder agreements I helped think forward the issues, those companies are worth $250 million now. And they are cashing out their investors in a positive way. They're litigating with their investors in a way to try to figure out, like, who owns what. And it happens quick in this industry because companies accelerate so quickly in this industry. You can easily go in 2 or 3 rounds of financing from a small company that's worth a couple of $1 million to $100 million plus in valuation. And this is the foundation that your company is going to be built on. So let's talk a little bit about it. Everybody knows that at some point, unless you're planning on doing this alone and not really having any kind of corporate presence, that you're going to have to do the things that we're about to talk about. The first thing you're going to have to do is form that entity, right? And that's really where you need to start thinking about this. Are you going to be a corporation? Are you going to be an LLC? It sounds fundamental, but a lot of people in this space have operated businesses for a long time, especially in the legacy industry, and haven't even had to take that initial step, right? What's the difference between a corporation and an LLC? There are lots of differences. There are tax differences, there are organizational and structural differences, there are managerial differences, but at the end of the day, what you're thinking about is, okay, I'm going to form this entity, and this is going to be the foundation for my business. This is how I'm going to be able to apportion equity to all the people, to my partners, to the people who have helped, who I want to incentivize with the opportunity to earn equity over time. This is how I'm going to protect my liabilities, right? You're no longer have to be a legacy operator where it's kind of all just based on handshakes. You're going to be able to enter into commercial agreements, right? You're going to be able to hold yourself out as an established, organized brand, and this is the foundational point for that. Historically, a lot of companies that we've represented have formed LLCs, and those are the operating agreements that we're going to talk about today. But today it's kind of 50-50 in terms of a corporation or an LLC. This is turning into a kind of a venture-backed industry where there are investors and funds who might want to invest in you, and a corporation might be easier to invest in that respect. But assume you're going to be an LLC. What people in your position are thinking about right now is, do I want to be based in Delaware or do I want to be based in New York, right? Historically, we would tell people to only stay in one state because you're trying to kind of organize yourself in a way that creates the least amount of federal nexus, because this is a federally illegal business that you're going to be operating. The industry has kind of evolved past that, and Delaware is kind of the standard state where other industries, if you were just a widget company or something like that, would tend to organize themselves. And so these days I tell people it might actually be easier to organize in Delaware and then get admitted to do business in New York. But there's a strong argument for being admitted in New York. After that, it really kind of segregates between what a corporation does and what an LLC does. And the fundamental principle on that is the operating agreement. What's interesting is that people, and we've had this experience a lot, people in the legacy industry have operated on handshakes, right? They handshake with the business partners that they launch their business with. There's a lot of trust there. The people, if you're a grower, the people that you're supplying to, the people that are processing for you, it's a handshake agreement, right? And in fact, they've avoided paper not only because it's kind of meaningless in that context, because it is more reputation based. There's not an opportunity to enforce the contract even if there's a problem. It just seems like unnecessary paperwork. But once you're organized as a real business, the operating agreement is that key contract between you and the rest of your partners, your partnership, and the rest of your investors, and basically everyone else that you're going to be doing business with to organize yourself and operate. And let me tell you this, people will say, well, I formed that online, I got my operating agreement from LegalZoom. You are running probably one of the most complex and sophisticated types of businesses that you can be running in a cannabis company. You have more regulatory oversight, more tax liabilities, more operational risk based on the kind of product that you're selling than almost any other business that you could think of. And you're an entrepreneur, you're a first time, you might be a first time go. So, this is the fundamental contract between you and your partners and you and your investors that's going to govern that relationship basically from inception through execution. So we'll go through kind of some of the key organizing principles of an operating agreement, and then I'll be here the rest of the day if anybody wants to talk to me and has any questions about kind of really how these things play out. But basically what you're going to be doing is establishing how you're managed, right? Are you going to be managed by your largest shareholders? Are you going to be managed by the founders and some others? Are you going to be managed by consensus, or are you going to be managed by a consolidated group of decision makers? You're thinking about your members. Are your members, just by virtue of the fact, and a member in this case means basically investor or shareholder in your company, are they going to have any input at all? Are they going to have input on key decisions? Or are they going to have input on all of the decisions? Are you basically going to be controlled by your constituency and the people who own your business, or is your business going to be run by the people that founded it, irrespective of the number of investors and other people who have stake in your business? And then a lot of times the question that comes up is, am I going to be able to incentivize my employees, my advisors? I want to give them all stake in the company, right? And the operating agreement is the fundamental document for that as well. You might be thinking, I have these wonderful employees. They supported me when I was in the legacy industry. Now they're supporting me as a licensed entity. I want to be able to help them participate in the profits. If you are a corporation, you would do that through an option plan, but as an LLC, you'll be doing that through a much more complex instrument called a profits interest, and I'm happy to describe that to anyone. But basically, it's an opportunity to participate either in the distributions made to the members on an ongoing basis, or in the ultimate distribution on sale. I've got a few minutes. I don't think we're answering questions, but I'm happy to kind of save the balance of my time if anybody has any other questions. Thank you very much for your time.